Most people think markets move because of headlines. They don't. Markets move because of pressure, constraint, and structure. And price only reacts after the system starts cracking. What we're witnessing right now in silver is not random. It's not hype. And it's definitely not speculation. It's stress. And stress always reveals the truth. One of the largest online bullion dealers in the world just quietly changed the rules. No flashy announcement, no warning. Just a new reality. A $500 minimum order, effective immediately. Let's be clear about what this means. This wasn't done to help customers. This wasn't done because demand slowed. This was done because demand became unmanageable. When a bullion dealer raises minimum orders, it's not about silver price. It's about logistics, inventory flow, and margin stress. Most silver on the site is now priced at $100 per ounce or higher once premiums are included. That means the new minimum order effectively eliminates small retail buyers. Why would a business do that? Because when demand explodes, order volume spikes, fulfillment slows, inventory drains unevenly, hedging becomes dangerous. So they did the only thing they could do without saying the quiet part out loud. They cut order count by 50% to focus on larger, higher value orders. That's not a marketing decision. That's a triage decision. This is what institutions do when supply cannot scale. Here's where most people get confused. They look at silver futures and say, see, the market is calm. But futures don't deliver silver. They deliver promises. And promises are cheap until they aren't. Physical silver doesn't care about interest rate narratives. Central bank speeches don't matter. Technical indicators don't matter. Physical silver cares about inventory. Refining capacity matters. Transport matters. Sovereign demand matters. Industrial consumption matters. And right now, all five are under stress. When a dealer raises minimum orders, it's not because silver is plentiful. It's because inventory velocity is breaking their systems. This is what happens before shortages become visible. While Western markets were busy arguing over charts, silver quietly did something historic in the East. Silver surged to over $105 per ounce on the Shanghai Futures Exchange. Let that sink in. Not a rumor, not a spike, not a glitch. A new all-time high. And here's the key point most analysts missed. This happened despite new position limits. That matters. Because when regulators impose limits, they're trying to cool speculation. But speculation didn't cool. Price didn't stall. Silver exploded higher anyway. Why? Because this wasn't speculative demand. This was physical-driven demand expressing itself through price. China doesn't play the same silver game as the West. In the West, paper contracts dominate. Leverage suppresses price. Delivery is optional. In the East, physical settlement matters. Industrial demand is real. Stockpiles are strategic. When silver spikes in Shanghai, it's not sentiment, it's need. For decades, silver has been managed through leverage. Hundreds of ounces promised for every ounce that exists. The system works only if most people never ask for delivery. Price stays psychologically contained. Physical demand remains fragmented. But something changed. Industrial demand surged. Solar, EVs, defense, electronics, all compete for the same metal. At the same time, mine supply stagnated. Ore grades declined. New discoveries collapsed. You cannot print silver. You can only promise it. And promises are now being tested. That's why price in Shanghai is breaking away. That's why Western dealers are rationing quietly. That's why premiums are screaming even when futures try to whisper. Critics will say, this is just hype. This is just a spike. This will cool down. Let's dismantle that calmly. Speculation collapses quickly. It spikes fast and fades faster. But physical stress behaves differently. Physical stress shows up as delivery delays, higher premiums, rationing, minimum order increases. Geographic price divergence. We're seeing all of it at once. That's not a bubble. That's systemic strain. If this were speculation, Shanghai price would crash on limits. Dealers would welcome small buyers. Premiums would compress. The opposite is happening. Now let's talk about the broader catalyst. For the first time since major tariff announcements, markets reopened. And the reaction was immediate. Stock futures fell. S&P 500 down. NASDAQ hit harder. Dow sliding. Meanwhile, gold surged. Silver surged even more. This isn't coincidence. When trade wars escalate, trust breaks down. Capital doesn't ask for permission. It doesn't wait for clarity. It moves to safety and tangibility. Silver benefits twice, as a monetary metal, as an industrial necessity. And unlike gold, silver inventories are thin. That's why silver moves faster. That's why it's more volatile. That's why suppression always breaks violently. Here's the part Wall Street won't explain. The silver market is too small to absorb institutional demand smoothly. A modest shift in allocation can overwhelm supply. Pension funds, sovereign buyers, industrial stockpiling. Silver isn't priced for scarcity. It's priced for paper abundance. Once that illusion cracks, repricing is not gradual. It's discontinuous. That's why dealers protect inventory. Exchanges raise margins. Regulators impose limits. These aren't signs of confidence. They're signs of containment efforts. Every bull market has skeptics. That's healthy. But this cycle has three elements previous rallies didn't have simultaneously. Structural supply deficit, industrial demand growth, global trust erosion. Add to that de-dollarization trends, weaponized trade policy, energy transition metal demand. Silver sits at the intersection of all of it. That doesn't guarantee anything, but it explains why pressure keeps building. Focus less on charts, watch who can buy, how much they can buy, where price diverges, who gets delivery priority. When access tightens, price follows, always. The market doesn't break loudly, it breaks quietly, then suddenly. History doesn't repeat perfectly, but it rhymes. Every time silver is constrained, paper control holds, until it doesn't. What we're seeing now is minimum orders, triple-digit pricing overseas, physical premiums exploding, markets seeking refuge. This is not a prediction, it's an observation. And the observation is simple. Silver isn't being bought because people are excited, it's being bought because people are nervous. And nervous markets don't unwind gently.